Welcome to EXP's discussion of ACCA Paper P4 Advanced Financial Management. Today we want to examine acquisitions and mergers, also popularly known as M&A, mergers and acquisitions. This is so central to the idea of financial management because managers need to know what the value is of the things they buy or the things they want to sell, or indeed of their own company, even if they don't have any intention of offering their own company for sale or to merge with another company. If there's no intended transaction, the desire and the need to know the value of something is an ongoing requirement for management, if only to be able to measure whether or not shareholder value is being created as the company is being operated. Now, Paper P4 is not looking at mergers and acquisitions from an accounting point of view. We're looking at it from a corporate finance point of view. It's a very practical paper, and therefore candidates would be required to be able to state cogent reasons in writing why companies would engage in M&A transactions, and here you have a couple of ideas which are suggested, also making a distinction between horizontal and vertical integration. The motivations are connected to issues of strategy and should fit the overall purpose of the company. Again, being very practical oriented, we should also take note of the fact that there is a fairly high rate of failure of mergers and acquisitions. In other words, one company taking over another company and not meeting all of its, or even most of its expectations with regard to the subsequent integration or the extraction or creation of value. One often speaks of synergies, much hoped for synergies, to be able to cut costs and to create greater efficiencies and economies of scale and all those sorts of nice things that CEOs talk about when they advocate and announce a takeover. But to actually achieve these things is not so simple, and it often lies in faulty implementation. Well, first of all, the motivation for buying another company has to be a good one, has to be carefully examined. You can't just do it spontaneously. And then secondly, once the deal is completed, and by completed I mean the company is acquired and the transaction is completed, the payment is made, then the real hard work starts of actually realizing value from the new acquisition. And that's not always such an obvious thing that's achieved easily by company management. So we can see that the paper P4 looks at mergers and acquisitions, and it's not solely concerned or only concerned with the price of the transaction, although that's very important. It looks at the whole deal in context to make sure that both financial and non-financial priorities are and factors are taken into consideration. For example, it may very well be the case that a potential takeover would be very interesting from a financial point of view for a company, but it's not worth doing because it may be simply too small in magnitude, or it may actually require too much in the way of management attention in order to complete the takeover and to achieve the integration in a successful way. Therefore, deals that look cheap could be rejected simply because, well, there may not be a good fit with the acquisition in the company's own strategic profile. Again, this reflects the discursive nature of paper P4, the need not only to crunch numbers, but also to be able to put thoughts together in sentences on the page. Very important. But of course, we mustn't forget the fact that in order to complete M&A, we have to have an idea of what the value is of something, and therefore valuation is part and parcel of M&A. Now, when acquirers, this means the buyers, they have to understand what the impact will be of the acquisition on the company's own profile, and here specifically with regard to the risk profile. In other words, we can classify the acquisitions according to whether they produce a change to the buying company from the standpoint of financial risk or business risk. So type 1 acquisitions is the simplest one because the acquisition itself does not have a significant impact on, in fact, we can say it has a negligible impact on the financial and business risk of the acquirer. Type 2 acquisitions would be both the buyer and the seller, or the target company, let's say, have the same business and therefore the same business risk. They're in the same industry, in other words, but they have different levels of financial gearing, and therefore that has to be brought that has to be reconciled. And finally, type 3 acquisitions, as one might guess, would be an acquirer which is going not only, let's just say, going outside its industry. It is going outside its industry to a different business activity, therefore it's altering the business risk, and the target company has a different level of gearing, and therefore this has an impact as well on the buying company. So we have to be aware of these distinctions when we look at different valuation methods. Book value methods have been discussed in paper F9, and therefore we needn't concern ourselves further here except to remind the candidate to dust off those F9 notes and have a look through them, because what you learned there is going to be very useful for having a strong basis in paper P4. Same is true for the price earnings ratio and earnings yield. These have been discussed in the context of paper F9. Continuing along here to other methods for valuing companies, the cash flow based methods, which constitute the best or the most robust methods, particularly when we get to the discounting of free cash flows. The dividend valuation method, DVM, the dividend valuation model, it's called variously, is based on the dividend flow which is expected from owning the shares. So this was also discussed in paper F9, and you may recall that this is a suitable method for somebody, for example, who is possibly a minority shareholder and therefore relies principally on dividend income to be able to generate the basis for determining the value of the company. When we value a share, an individual share, we are kind of valuing the whole company indirectly. So in this case, the dividend valuation model gives us the price of a share if we know what the cost of capital is, what the return requirement is for an investor. The cost of capital here, cost of equity in this case, being the required return that an investor needs to compensate for the riskiness of the cash flows of the company. Now, what are the cash flows that are relevant to a shareholder? A shareholder buys the shares and therefore receives dividends. So it's the riskiness of those dividends projected into the future, possibly with a growth factor, which is denoted here by G. This dividend valuation model gives us the possibility to put these things together and come up with a price of the shares itself. And when we have the price of one share, we can multiply by the number of shares which are in issue to come to some general opinion as to what the value of the entire company could be. Of course, one could say that if you can buy the whole company and exert control over it, that's giving you a greater benefit than simply buying individual shares as part of a minority shareholding, and therefore the sum of these parts may actually be greater than the individual parts themselves. We have to leave that discussion for next time when we take a more global view. What happens if a company buys another company, takes it over, and therefore may even change the dividend policy of the company they take over? The key thing is to look beyond dividends and to examine free cash flows. Thank you.